Thanks for clicking. The Bank of Canada's interest rate hiking cycle may be over. This according to the Financial Post's account of Governor Macklem's speech on Wednesday.
Didn't I say?
In this account of the speech, this stress on the end of rate hikes was echoed all across the media.
Nobody listened to me.
Bloomberg went even further in the hype, noting that bond yields rallied following the release of the speech's text, with yields down on two-year government bonds down close to 4.4%. Yet, the headlines and the commentary don't exactly match reality, as the two-year bond ended the day off 0.01% lower than it started, hardly a rally to speak of, and the 5-year ended the day higher. And the reason for the divergence between the bond market, which lives in at least quasi-reality, and the headlines, which don't, is that the headlines were based off a single line in an appearance that took an hour and a half, during which the governor discussed a lot more, including the new mortgage charter, growing government debt, and lessons from the 1970s. So what I want to do today is go over the governor's appearance, unpacking what he actually said about Canada's interest rates, go over what he had to say about the mortgage charter, government debt, and lessons from the 1970s, and then discuss what to look for next. Speaking of next, the end of the month is fast approaching, and with that, we're eagerly awaiting November's real estate data coming out from the local boards, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into the speech. On to the governor's speech. First up, let's quickly address the headlines, where the governor said that monetary policy might be restrictive enough.
This tightening of monetary policy is working, and interest rates may now be restrictive enough to get us back to price stability. But if high inflation persists, we are prepared to raise our policy rate further.
That was it. That's what caused the widespread headlines, but wasn't that different than any other policy announcement that we've seen over the past few months, with even the governor noting that this wasn't a big change.
I've said previously, monetary policy may be sufficiently restrictive. Interest rates may be high enough to get inflation back to target. Yesterday's number was certainly encouraging, but 1 month CPI is not a trend.
Yeah, as mentioned, despite the headlines, the bond market didn't really care, predicting no additional changes in the policy rate than it was prior to the speech.
It's a whole new ballgame out there, sir.
Speaking of no major changes, by my count, the governor was asked 3 times when we can expect to see interest rate cuts.
What specific economic indicators or measures will the Bank of Canada need to see in order to decide when it's time to cut the interest rates?
That has a lot of Canadians wondering, when do you expect we will be at that point where we'll be able to start lowering those interest rates and getting back to?
How many quarters do you expect spare capacity to build up to a point where you're ready to discuss rate cuts?
I won't go through each separate response, as it's the same every time. It's the same at every press conference when the governor is asked about rate cuts, noting that it's too soon to talk about cutting interest rates.
Right now, it is not time to start thinking about cutting interest rates.
As a brief side note, these reporters, you have an audience with the governor of the Bank of Canada, arguably one of the most powerful people in the country, and you ask the same ridiculous question over and over and over again. Ridiculous because there's no way he's going to answer it. They ask the same question at least 3 times, the same question that's been asked at every other press conference, and received the same answer.
I'm kind of a big deal.
But I digress. The governor was then asked about the recently announced Canadian mortgage charter. The governor was questioned that if higher interest rates are meant to slow down the economy, take money out of the economy, and the mortgage charter allows people to extend their amortizations, lowering their payments, then isn't the charter working against the bank's efforts to lower inflation, take money out of the economy?
The federal government is formalizing a so-called charter of mortgage lending, which allows a lengthening of amortization and other relief for borrowers in difficulty. Is there a risk that if people keep getting stuck on repaying their loans, it will alter your inflation fight or introduce some other instability in the financial system?
For his part, the governor could have done better.
Households that are, having real difficulty paying their mortgages are not households that are contributing too much to spending in the economy.
The point is well taken, but maybe don't laugh. Regardless, the governor went on to say that the bank doesn't want to see anyone lose their homes, and to that extent, they're okay with the mortgage charter.
To the extent that the people that are, really having difficulty, there's a way for them to work through those difficulties. That's a good thing for everybody.
With that said, as we discussed in a previous video, it's pretty easy to support the mortgage charter considering it didn't really change anything. Speaking of the fiscal update, given the governor's previous comments that government spending wasn't helping with the inflation fight, Governor Macklem was asked whether or not the new fiscal update was more in line with combating inflation.
You previously said governments were not rowing in the same direction as monetary policy. Does this update start to do this?
For his part, the governor noted that while the fiscal update doesn't help or hurt in the immediate term, there is some additional spending for which the Bank of Canada is going to have to account.
Other things in the fall economic statement. Beyond 24-25, there is some additional spending. We will be building that into our outlook, and if there are any other provincial updates, we'll be building that into our outlook, and we'll be publishing a new economic outlook in January that will build that in.
Your warrant don't ever go over my head again.
Indeed, there's a few things to unpack here. If you'll remember back in July when the bank published its monetary policy report, it rolled back its estimates of when inflation would return to 2% by 6 months. The announcement was a major surprise to the markets, and even the CREA downgraded its housing market forecast 2 days later. That was an actual headline-inducing event, based off a substantial change in the Bank of Canada's projections.
See the difference?
The next monetary policy report is set to be released in January, and the bank is warning the federal government and the provincial governments that the bank could update its projections, could push back its inflation estimates again, if spending is not kept under control. I really don't think he appreciates those letters from the premiers. And finally, the governor stressed throughout the appearance, throughout the Q&A session, throughout the press conference with the reporters, the lessons learned from the 1970s, when we had high employment and high inflation, or stagflation, which we've talked about on this channel so many times. The governor said something that really didn't match the tone of the headlines.
Getting back to the previous question, the lesson from the 1970s is you don't want to be half-hearted in your efforts to get inflation back to target.
And yeah, we've talked about this before on this channel, even covering a report from the IMF, which studied 100 cases of inflation. The report found that countries in the 1970s, like Canada, which prematurely celebrated the death of inflation, saw it re-accelerate later. And we can see this clear as day in the data in the 1970s. Inflation went up, the policy rate followed to bring inflation back down, we saw inflation recede, and inflation shot right back up again. And, judging from this press conference, the Bank of Canada is well aware, well acquainted with monetary history.
Nah, you don't need that.
So, in summary, yes, the governor says that the bank may not need to raise rates again. However, this policy wasn't new. The governor also expressed his support for the mortgage charter, warned about government debt, and stressed the lessons learned throughout the 1970s.
In the 1970s showed us that I was a teenager in the 70s.
So, while we may have seen the last of the rate hikes, that will be inflation dependent, as even the Bank of Canada governor says they can't predict. The focus on the 1970s tells me that we have a central bank well aware of what happened when the bank cuts rates too fast, when the central bank cuts rates prematurely. The focus on the 1970s tells me we have a central bank that is going to want to see demonstrable evidence over a longer period of time that inflation is returning back down to 2%, that core inflation is moving down to 2%, core inflation which is moving down much slower than headline. With that said, we will continue to track the Bank of Canada and its efforts to get inflation back to target on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.